In a traditional market crash, asset prices plummet, creating a ripple effect through economies. But a reverse market crash, now that's a different beast altogether. Here, we see an unprecedented rise in asset prices, but not in the way you might think. Instead of a healthy, gradual increase, this is a rapid, almost unnatural surge. It's like a roller coaster that only goes up, and the ride can be just as stomach-churning. The implications of such an event are far-reaching, affecting everything from personal investments to global economies. So strap in and get ready for an enlightening journey into the heart of this intriguing financial phenomenon. To understand the reverse market crash, we must first look at the events leading up to it. The year 2023 was a tumultuous period in the global financial landscape, marked by several significant occurrences. Notably, the fall in global house prices was a major event that sent ripples through the financial markets. According to a survey of nearly 100 housing market analysts, house prices in most major property markets were expected to drop. However, the anticipated declines were not expected to make housing more affordable, as they would only amount to about one-third of the gains seen since the pandemic's onset. Countries such as the United States, Canada, Britain, Germany, Australia, and New Zealand all experienced significant increases in house prices since 2020, driven by low interest rates and increased demand for larger living spaces due to remote work. While prices began retreating from their highs, they remained moderately expensive in most markets. Higher mortgage rates and inflation were expected to weigh on demand and home prices in the coming years. In addition to the global house price fall, the financial landscape was further shaken by a credit crunch. The American economy faced uncertainty as GDP growth slowed, companies announced mass layoffs, and inflation remained high. Regional banks, including Silicon Valley Bank and potentially First Republic Bank, were also in turmoil. This credit crunch, despite some upbeat earnings, added to the economic uncertainty and created a challenging environment for large institutions. These events, coupled with other factors, created a perfect storm in the financial markets. The global house price fall and the credit crunch played significant roles in destabilizing the economic landscape, causing a shift in market dynamics and investor behavior. These events set the stage for the unprecedented reverse market crash of 2023. Now that we have the background, let's dive into the reverse market crash itself. The reverse market crash of 2023 was a unique phenomenon, unlike any market crash we've seen before. While traditional market crashes are characterized by a rapid plunge in prices, the reverse market crash saw a sudden and unexpected surge in the value of assets. This was caused by a combination of factors. The first was the sudden shift from a seller's market to a buyer's market in the housing sector. House prices in major economies like the United States, Canada, Britain, Germany, Australia, and New Zealand had been on a steady rise since 2020. However, in 2023, these prices started to retreat from their highs, marking the beginning of the reverse market crash. The second factor was the economic uncertainty, characterized by slowing GDP growth, mass layoffs, and high inflation. This led to a painful credit crunch, further fueling the reverse market crash. This was especially pronounced in the banking sector, with regional banks like Silicon Valley Bank collapsing and First Republic Bank on the brink of following suit. So how did this affect the financial market? Well, as the value of assets surged, investors who had bet against these assets found themselves in a tight spot, leading to a massive short squeeze. This further drove up the prices, creating a vicious cycle. However, it's important to note that despite the sharp increase in asset values, this did not necessarily translate to increased wealth for everyone. As the market became more volatile, many investors were left struggling to navigate the unpredictable swings. The reverse market crash was a unique event in financial history, but what does it mean for us as investors? As investors, we are naturally interested in the effects of such a crash on our investments. In the wake of the reverse market crash of 2023, various types of investments felt the impact differently. Stocks, for instance, took a significant hit. As the markets dipped, investors saw their portfolio values decrease dramatically. This was an unsettling time, with some investors seeing their life savings dwindle. Real estate, on the other hand, experienced a more complex scenario. House prices in most major markets fell, but not as drastically as some might have expected. Despite the decline, housing did not become more affordable due to the previous gains since the start of the pandemic. Now, let's talk about the reaction of investors. Some, particularly those with a more conservative approach, chose to reduce their risk exposure. They moved their investments into safer, albeit less profitable options such as bonds and cash. This strategy helped them to mitigate the immediate effects of the crash. However, others saw the crash as an opportunity. These folks, often with a more aggressive investment strategy, went bargain hunting. They looked for undervalued stocks, real estate, and other assets that had been hit hard by the crash. Their belief was that these assets would eventually rebound and provide significant returns. And then there were those who chose to stay put. They held onto their investments, weathering the storm and waiting for the markets to stabilize. This strategy required a lot of patience and a strong belief in the long-term strength of their investments. It's important to remember that there's no one-size-fits-all strategy when it comes to investing, particularly in times of market turbulence. The best approach depends on an individual's financial goals, risk tolerance, and investment horizon. While the reverse market crash posed challenges, it also offered unique opportunities for savvy investors. It's important to learn from history to better navigate the future. In the wake of the reverse market crash of 2023, several crucial lessons emerged that carry implications for the future. First, the crash underscored the importance of diversification in investment portfolios. By spreading investments across different asset classes, sectors, and geographic regions, investors can better insulate themselves against the kind of systemic shock that characterized the crash. Second, the crash served as a stark reminder of the inherent volatility and unpredictability of markets. Despite sophisticated models and predictions, markets can and do behave in ways that defy expectation. This lesson underscores the importance of risk management in investing. It's not just about chasing high returns. It's also about managing downside risks. Third, the crash highlighted the significant influence of macroeconomic factors on markets. In this case, high inflation and the cooling of the housing market played key roles. This awareness can help investors better understand the broader economic environment and its potential impact on their investments. Looking to the future, these lessons carry significant implications. Diversification and risk management will continue to be crucial strategies for investors. Additionally, an understanding of macroeconomic factors can help investors anticipate market trends and make more informed decisions. Moreover, the crash has spurred discussions about the need for more robust financial market regulations to prevent such extreme market fluctuations. While the exact nature of these potential regulations remains to be seen, it's clear that they could have significant implications for investors. Further, technological advancements, such as the growing use of artificial intelligence in financial forecasting, may also influence how investors navigate future market crashes. These tools can provide more sophisticated analysis and predictions, potentially helping investors to react more quickly and effectively to market downturns. Armed with the knowledge of the past, we can move forward more confidently into the future of investing. Looking beyond the horizon of the reverse market crash of 2023, we now pose the question, what can we anticipate for 2024? With the lessons of the past etched in our minds, let's project into the future. In terms of potential market trends, it's crucial to monitor key economic indicators. Watch out for shifts in employment rates, inflation figures, and GDP growth. These can provide invaluable insights into the market's possible trajectory. Moreover, the role of government policy cannot be underestimated. From fiscal stimulus measures to regulatory shifts, these can dramatically shape the financial landscape. Additionally, keep an eye on global events. From geopolitical tensions to technological breakthroughs, these can send ripples throughout the market. For investors, the key is to remain adaptable. Diversify your portfolio to spread risks and consider long-term strategies that can weather potential market storms. 2024 may bring its own set of challenges and opportunities, and it's essential to be prepared. While the future is uncertain, being informed and prepared can help us make the best investment decisions. In the end, the most successful investors are not those who can predict the future, but those who can adapt to it. As we embark on our journey into 2024, let's remember this and keep learning, adapting, and growing in our financial journey.